The idea that it's prosperity that causes inflation may not have any factual support in history, but since when did facts ever interfere with Washington policymaking?
That was Louis Ruckhiser back in January of 2001. 20 years later, that debate over what causes inflation is dividing economists and policymakers once again, in a time of easy money and a $1.9 trillion infusion of support into the economy. We asked economist and Wall Street Week special contributor Larry Summers and historian Hoover Institution's Niall Ferguson about what we can learn from the history of inflation.
I think it's part of a continuum of acts by democratic administrations that have expanded the role of government in alleviating poverty and economic hardship. So you can trace a continuous line, if you want, from the New Deal through Lyndon Johnson's Great Society to this. But there's a difference. This is a very, very large amount of money relative to the US economy, and it implies very large deficits by the standards of peacetime. Remember, the CBO put last year's deficit at close to 15% of GDP, and its latest projection for this year's is around 10%. These are very large deficits in peacetime, and they come at a time when the federal debt has reached its highest level since the end of World War II. So I think there is a kind of key question here, which really has to do with the macroeconomic implications of pouring quite a lot of fiscal fuel on the fire of an economy that is already coming back rapidly from the pandemic, thanks to vaccination and our rapid approach of herd immunity. Now, I'm treading into Larry's minefield of macro here, so I'm going to step back and let him comment. But I do think that the historical significance is really in terms of scale and the timing of such a large fiscal stimulus to the economy.
So Larry, we've heard something similar from you in the past. Now that we have the bill, it really enacted into law, what's the best thing that can happen because of this and the worst from an economics point of view?
Let me just say on the Democratic tradition, there's a thing here, the refundable child credit, which is less than 5% of the total stimulus that we're providing this year, will almost certainly be continued and will make an immense contribution to reducing child poverty in America. And it's a very, very positive thing and a huge historic achievement. But it's 5% or less of the total stimulus this year, and it's something that will continue. I think the decision to put $1.9 trillion of stimulus on top of $950 billion of stimulus will set the economy on fire with growth at 7% or more this year, assuming we progress against COVID, and I think is playing with fire. A simple view would be that I think there's a 1/3 chance that the Fed will stay behind the curve, inflation expectations will ratchet upwards, and will become an inflationary country for at least a time above the 2% target. A second risk is that the Fed will respond, that given all the things they've been saying, their sharp response will be unexpected by markets. And as has been the case in the past, when the Fed has had to step in to stop an incipient inflation or incipient bubble, it will be a chaotic process with very substantial instability and possible recession. And I think there's a 1/3 chance that somehow the needle will be threaded and that we will enjoy a period of very rapid growth, and there will be a smooth exit back to reasonably rapid, reasonable, okay growth. But I think that we are taking very substantial risks, both on the inflation side and on the fiscal monetary collision side. That's why if things continue on trend, the interest rate in the first quarter of this year will have gone up faster than in any year in the last century, except for 1980. That's why you see increasing numbers of indicators pointing to more rapid inflation, pointing to the development of possible labor shortage. So I think there are very substantial risks on the path that we are on.
Niall, you wrote a piece, a terrific piece for Bloomberg Opinion, actually, on the subject of the history of inflation, going back to Milton Friedman, what happened in the 60s and the 70s. I must say, I have youngsters in the newsroom who come up to me and say, I wasn't around for inflation last time. How does it work? Are we in danger? What do you say to those people? Is this in any way parallel to what we saw in the 60s and the 70s?
Well, I think it's worth looking at the 1960s because I suspect younger people have a pretty hazy idea of what happened with inflation before they were born. And the typical view, in my experience, is, well, that was something that happened in the 1970s because of the oil shock. That's not quite right, actually, because what happened in the 60s was that in the first half of the decade, inflation was low, it stayed well below 2%. And then in the mid-60s, it took two big jumps, first up to 3%, then up to 6%. And that was the moment that inflation expectations became unanchored, as we would now say. And I think the key here is, what can we learn from that experience? So that was an increase in inflation that predated the 1973 events that caused the oil shock. And it's often blamed on mistakes by the Federal Reserve. That was the view of the late Alan Meltzer in his history of the period. And indeed, people at the Fed at the time acknowledged by 1968 that they'd got it wrong. Now, the monetarist view was that monetary aggregates had been growing too fast, and that was the reason things went wrong. My view as an historian is that that's kind of a simplistic view. It's almost tautological to say that inflation is always and everywhere a monetary phenomenon, which was Friedman's view. It's partly a fiscal phenomenon. And this is, of course, what Larry has been arguing in his recent commentary, that if you do really large fiscal deficits, that has potentially inflationary consequences. But the key is expectations. The Fed today seems to have a theory that inflation expectations will not be affected if there is a temporary bump in inflation in the second half of this year or the beginning of next year. I don't think that's historically very well founded. The lesson of the 60s is that if you do the Great Society, if you do butter and then you do guns as well, which was Vietnam, then you can get inflation expectations unanchored. And I tried to make the point in this piece, because I don't want to be called an inflationista a second time. I plead guilty to having been more worried than I should have been about inflation back in 2010. I think what made the 60s different is that they were losing a war in Vietnam. And we're really not in any comparable military engagement. You know, Afghanistan, yeah, we're still there, but the presence is tiny. I think what would change the game today, and I want to emphasize this point, would be if the US and China suddenly got into a serious foreign policy crisis over, say, Taiwan or the South China Sea. That historically is the kind of thing that time and again has caused inflation expectations to jump. And I have a chart in the piece which goes all the way back to 1688 for the UK, showing that nearly every time inflation expectations in the UK surged, it was because of a war, and usually a war that was going wrong.
So Larry, as I recall, you're one-third. You had two-thirds with inflation that something needed to be done about, whether it was or not. The first one was it gets out of control. The second one was the Fed has to act too sharply. Is there a way, what is the proper way for the Fed to manage that right now to avoid those two alternatives?
I think they need to become much more attentive in their rhetoric to the risks of inflation and the need for action. The Fed traditionally makes clear that it's going to be preemptive with respect to assuring price stability, limited inflation. Now the Fed is mostly concerned with preempting the possibility that it would have to raise rates by explaining how if there is inflation, it will just be transient and so forth, by directing attention not just to employment goals, but to employment goals for specific demographic groups. I think the Fed says inflation expectations are well anchored, but they say it in a way that becomes a self-denying prophecy, as if they believe that the fact that inflation expectations are anchored relieves them of the obligation to act in the traditional central banking way to be determined to contain inflation. Look, I think the biggest difference between now and the 1960s, I don't know whether I agree or disagree with Niall's geopolitical theories of inflation. What I do know is that LBJ's guns and butter was about 2% extra on the federal deficit, and that interest rates were a few percent, and nothing like quantitative easing was imagined in the 1960s. That today we've got extra stimulus closer to 10% of GDP. We've got interest rates not just at zero, but the central bank vowing to keep them at zero. And we've got QE. And so that tells me that potentially we're doing the 1960s on steroids, and we're doing it for the same basic reason we did it in the 1960s. We'd lived through a substantial period of anchored inflation, so we were complacent about the inflation threat, and we had needs that political leaders felt were pressing and wanted to push on with. So I think the dangers of repeating in some way the 1960s experience are very great.